The futures on the second to last day of the year are pretty steady, showing minimal declines headed for the indexes after a modest drop yesterday. Joining us now is Ross Mayfield, Baird investment strategist. Ross, good morning. So we're, have a strong year. S&P up 17+% on a price basis in 2025, although kind of coasting into the close here. We're pretty much flat with levels we got to 2 months ago. A lot of rotation underneath. What's the setup for 2026?
Yeah, I think the big thing that is what you just said is that this hasn't been a sell-off or a weak market, but a rotational one, and into the kind of, in a lot of places, cyclical, real economy type stocks that people want to see participate. So I think it's really encouraging that the market has been resilient in the face of some of the, AI weakness or skepticism, which I think is healthy in and of itself. You don't, in my opinion, see that in a true bubble. So I like the setup here. I think rates look well tamed. It's a global bull market, global participation, as I think somehow still under discussed. So I think there's a lot to like, which is, maybe the big thing to be concerned about is strategist price targets continue higher and higher. There's a lack of volatility, and I think sentiment, it runs the risk of being the thing that could knock this off in the first quarter a little bit.
Yeah, if you do look at the consensus projection among strategists relative to the S&P itself, it's definitely looks like there's a pretty big upside gap there, which in years past has sometimes meant those converge in some ways. To say it's a rotational market implies that maybe there's going to be continued shifts along the way. So if I look at the laggard type categories from this year, things like quality and value, do you think those are set to get revived or will continue to work in a cyclical way? Or is this something where we're going to go back to the AI leaders?
Well, look, I think AI leadership will probably resume. And I think if you're a broad market investor, you want that to happen. But just because the big 7, big 10 tech stocks are working doesn't mean that things underneath the surface can't be working as well. And I think it's a healthier market if things like banks and financials are participating. We've seen a nice, rebound in recent weeks from discretionary. I think, maybe not an all clear on the consumer, but certainly a little bit better than the consensus narrative. So, yeah. And again, I really want to hammer the global breadth, right? It's not just been a U.S. story. It's not just been a U.S. tech story. You've seen Japan, Europe, emerging markets work. So I do think that it can continue. I think I want to keep kind of a quality tilt on, occasionally when we dip into value, you're going down the quality scale. I think in year 4 or 5 of a bull market with rates proving fairly sticky above 4%, you still want to have a quality tilt on, which is important if you're kind of fishing in those value sectors.
Yeah, quality. I mean, just as a general characteristic, I was just looking on the S&P, quality trades at like exactly the same as the market multiple. In other words, no premium is now being assigned to the higher quality stocks. Maybe that is a little bit of a wrinkle you could play this coming year. You say, rates kind of sticky on the longer end. Is that going to persist if we get, let's say, a couple more cuts on the short end?
Yeah, I think so. I mean, we've seen a steepener lately. I think the long end of the curve is just responding to different forces than just the Fed. Now, I think in part, the market knows that the Fed is not going to be able to reasonably cut much below, a neutral rate of like 3.25, with inflation doing what it's doing and with the economy strong, with no recession really in sight here. And then on the long end, it's the same story as usual. It's fiscal concerns. It's some maybe concerns about Fed independence, given this Fed chair race we're in. And a stickier inflation environment amid broader themes of deglobalization and supply chain reshoring. That is expensive, and so I think that there's a bit of a reflation trade, a bit of inflation pressure, along with some of the usual fiscal issues or concerns that keeps the long end, maybe above 3.5 at its floor. I don't think that's a problem for equity markets until the 10-year starts pushing up towards 5% again. And we might see that in 2026. I think there's a good chance we do, in fact.